Welcome to my channel. I'm the cover call guy, and this video was left by a comment by João at 4944 from Brazil. I think that's how you say it. I think that's a Brazilian Portuguese name. This video was left a comment by João. It's about the safe consumption rate and how much to reinvest in order to keep up with inflation. Again, this is going to be based on me, an American that live in America. I'm not Brazilian. I don't live in Brazil. I don't know anything about Brazil or your situation. Say, if you make American dollars living in Brazil, that's a whole different story. That itself is already beating inflation. So you're going to have to tweak some numbers and then do a little bit of math yourself and see how much you need to be reinvesting and how much to be putting away. Because if you're making, your local currency is a whole different story versus you're making American dollars living in Brazil. You might not have to even reinvest at all, right? Because your American dollar, it's going to be a lot more stable. It's not, you're going to be making, you know, 3, 4, 5 times the amount. Um, I, so you're just gonna have to go through the presentation and just tweak the numbers and percentages. But before we get started, legal disclaimer: this content is for informational, educational purpose only, and is not financial advice. I'm not a licensed financial advisor or tax professional. All opinions on my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making any financial decisions. I am just some random idiot you found online, and I could be completely wrong. Now, with that out the way, let's get started. All right, living off cover call ETFs without letting inflation devour your purchasing power. We're going to look at a strategic analysis for us income investors. All right, from accumulation to consumption phase, right? What that just means is accumulation phase, like myself, I'm in accumulation phase. Focus is on total return and capital appreciation. Volatility is an opportunity to buy lower via dollar cost averaging, guys. Time heals drawdown wounds, right? Embrace these red days for the past week, maybe week and a half. All right, we're in accumulation phase. We want to buy things for the cheaper. Now, if you're in consumption phase, which I think Jerome 4944 is. If you're not, uh, I forgot. I think you said you were. All right, then now your focus shifts to cash flow stability and purchasing power. Right, volatility becomes a liability due to sequence of return risk, SORR. You might want to do a little bit more research on that. I'll probably make a separate video on that, but this is what you're afraid of, right? High nominal yield alone is insufficient if principal erodes. Sorry, sipping coffee. So basically, SOR might not affect us income investors as much as somebody who does the withdrawal rate, 4% withdrawal rate from growth stock. So we live off the income and we don't have to actually sell. So SRR won't affect us as much or won't affect us at all, but it is something to keep an eye on. Right, and my picture couldn't load, but pretty much the slide explains it. Right, the collapse of the traditional 60-40 paradigm. For decades, the 60-40 portfolio relied on bonds to provide yield and act as a shock absorber. And you mentioned if the market goes down, what happens, right? This is pretty much, it won't really affect us income investors as much, especially if you've done well in the accumulation phase. Right, you always overshoot what you're expected to spend, right? So when you're younger, you are going out more, you're eating more. When you start going into your retirement phase, you might not really care about going out as much. And if you do, then you have to make sure you are keeping pace with what you're spending every month. You want to shoot above an extra 20%. So it's a little bit of math, but it is simple math, and you just have to kind of calculate. Okay, I have enough for retirement. All my bills are paid. How much do I have left? All right, let me aim a little bit higher. So you just kind of have to um, give yourself that extra buffer. Like me, I'm aiming for at least 10K a month. I might want to shoot for 15K a month just because the extra $5,000 will give me that extra buffer. I might not even need that extra 5,000 a month. It will just be collecting every single year 60. That's an extra $60,000 a year that I'm just gonna reinvest, right? So that would push me up for the next you know uh leg up with my salary, and then I now make 200,000 and then I don't need that extra, and it just keeps getting reinvested. So back to the 60/40. So the post 2022, which I believe the economic landscape challenged these assumptions when inflation caused equities and bonds to decline simultaneously. Now this is not like right here. This is not like facts. Well, it's facts, but this is also facts in my opinion that in 2022 we saw that sharp inflation in the United States and globally, right? And so anybody was holding that traditional 60/40 got screwed because as that 40% um basically was fixed yield, right? It's like social security for those in America and Americans. It's a fixed income, and if prices go up, like just shoot up 10-15%, right? Or whatever, rates that you believe. But I didn't believe the inflation is only 3 4 5 6% from the Federal Reserve, right? So if it shoots up and gas doubled or tripled in most states, you were screwed. I don't think this portfolio going forward is going to work anymore. Right, so despite recent rate hikes in 2022, the real yield on high quality fixed income remains historically low for low durations. Right, the yield starvation has forced investors towards covered call ETFs, which promise equity like returns with bond like yields. So it's pick and choose, and I believe covered call ETFs are pretty much the future now. The 60/40. It's pretty much dated, and I don't think it's really going to work anymore like that. Right, the engine, right? These are some things that you should just know, definitions, right? And I just kind of m- m- bro- broke it down a little bit, right? um, VRP, that just means it's a way kind of like selling insurance, right? The fund gets paid a premium to take on the risk of a market. It swings. It's like selling flood insurance on a rainy season, right? So VRP just means uh, volatility risk premium, or depending on who you're talking to, variance risk premium, right? The compensation investors earn for taking on risk. So the higher risk, the more premiums get paid out, simply put. All right, and then there's the delta, which is the market sensitivity, how much the fund moves when the moves with the market. If the market rips up, delta is what forces the cap to kick in, eliminate your gains. Then we have data, which is time decay, earning money just by waiting. Options lose value every day to get closer to expiration. The fund pockets this loss as profit. And then Vega, right? Volatility sensitivity. How panic affect prices when the market is scared. High volatility, option premium spike, which can temporarily hurt the fund's value. So you can always track the VIX, VIX. It's an actual thing you can track, right? And that ticks that the VIX affects everything here. The VIX. You just look at the VIX, right? The lower the VIX, the more calm. The higher the VIX, the more panic. Right? That's the easiest way to understand it. And if it's somewhere in the middle between 15 and 25, it's a up and down choppy market, which is fine too. Cover call ETF do well in choppy markets. And this kept deleting itself, so I was like, whatever. I'll just explain it, right? The buy high trap, right? NAV erosions, high yield ATM funds, not ATM, at the money funds, often cap upside completely. When market drops, they fall. When market rise, they are capped. This leads to structural decline in principal over time. So know what you own, know what your cover call will do, right? So you don't want to be capping yourself in profits when the market's uh, going down and or inflation is going up with the market going down. So know what you own, right? Know what you own. Purchasing power decay. A fixed income stream loses about 3% of value annually. That's just the report. If you believe it, if you don't believe it, it's much higher. I'm just putting actual numbers given out by the government. So again, I don't live in Brazil. I'm not Brazilian, so you're gonna have to figure that one out yourself. Maybe it's 10%, maybe it's 15%, right? So just know how much you're losing every year, so you know how much you need to invest every year, right? So over the course of 20 years, purchasing power is essentially halves without growth. So just a little bit of math there, right? All right, the safe consumption rate, the SCR formula. So once you kind of figure this out, you know how much to maintain purchasing power, right? You must subtract inflation and maintenance cost from the nominal yield, but SCR equal yield minus cost repair, right? Cost inflation, right? A nominal yield is basically the headline distribution rate. What does the cover call claim pays out? 12%. Well, what's inflation? Reinvestment needed to grow up principal by CPI 3%. What's the NAV repair, right? Buffer for structural erosion and capped funds 1 or 2%. So you just kind of have to, you know, do a little bit of math and you always overshoot. You always want to overshoot because one, the fund may not pay out 12%. And if it does pay out 12%, what is the NAV gonna what happens to the NAV, right? So a lot of things affect it. And you just have to figure out, do I need to have more dry powder on the side? Do I need to overshoot my retirement number? I don't know how much 3,000 US dollars in Brazil is gonna get you, how far that gets you. Maybe you need 4,000. Maybe you need 4,500, or maybe $3,000 a month in Brazil. You live like a king. I don't know. I've never been to Brazil. Um, I don't even know if I know anyone who's Brazilian. I've probably met a few, you know, um, people from Brazil visiting the United States, but personally don't know like anything outside of just reading the news and what's going on in Brazil. So that one you're gonna have to figure out. Um, I was gonna try and make a video based on Brazilian like inflation and how much you would need, but I think I felt like that would be too inaccurate just because I have too many secondary sources that I don't have like a primary source, someone to ask, and I just felt like that would be an incomplete video, so I just did it based on me as an American living in America. You just have to kind of adjust your numbers to you know what I'm giving you, the information I'm giving you. All right, the fund taxonomy, right? Core strategies, again, systematic at the money, right? Right, monthly ATM calls on 100% of your holdings, highest yield but highest risk erosions, active out of the money, right? Defensive equities plus ELNs, lower yields but captures upside, and then risk, of course, is counterparty risk via ELNs and higher taxes. And then we have the high frequency, right? Uses daily out 0-day expiration options to reset cap daily, capture intradays move better than monthly funds. And then we have the specialized engines, right? These are the tax efficient NEOs. They specialize in just this. Use call spreads in Section 1256 contracts, high yields with tax efficiency. Then we have the yield canyons, right? Everything about yield, yield, yield. Pay out as much as possible. Concentrate bets on volatility, like big tech, massive yields, but high swings. And then we have the growth, right? And then partial coverage, lower yield, but significant capital appreciation. So it's just a matter of what you own and how you kind of combine each other. I'll get into what I mean by that. Right, the tax labyrinth. You just know what you're gonna have to pay in taxes. I don't know how Brazil does it. I don't know how Brazil is gonna tax you. Maybe you have to you're gonna get taxed a foreign covered call ETF, and then you get taxed again in the country of Brazil. I don't know. You're gonna have to you will have to kind of calculate that. All right, reinvestment requirements by fund type. So we do like just say you own QYLD. Nominal yield is about 11.5. Cost inflation, inflation NAV repair 2%. Let's just say it drops 2% every time it pays out. You're gonna have to reinvest at least 6.5%. So not worth it. And then high frequency daily, right? Nominal yield as of right now 9.5%. Inflation cost 3%. NAV repair 0.5. You're gonna have to do 6%, right? Active out of the money. The yield they're claiming right now is 7.5%. Inflation 3. NAV repair nothing, right? It stays solid. It's very good. You only have to reinvest about 4.5% to stay safe. And then of course we have the yield canyons, right? The 25%. Inflation is 3%. NAV repair is 5. You have to reinvest 17%. All right, this is all illustrative for the most part, right? I kind of have to put it together. It's you're gonna have to figure out how much you're getting per month, how much whatever you own. I don't know what you own. Um, is the NAV stable? If the NAV is stable, right, then you're gonna save a lot more money. I don't know how much your inflation is in Brazil per year. You're gonna have to figure that part out and see if it's even gonna be matching what you're being paid out. right? So if you're making American dollars, then you might not even have to worry about this, because American dollars itself, it's already a hedge against your inflation, right? So and this is what I mean by what you own, right? The diversified income matrix. You can kind of mix it up to try and create a self-healing income stream, right? The massive surplus yield from the yield boosters isn't spent; it's funneled into buying back more shares of the growth engine, right? And this forces you to buy low accumulated assets that naturally fight inflation, effectively automating your own raises every month, right? So these yield boosters will feed into this, and this can feed into this, or this feeds into this, right? It just depends how much of your income is, right? And then pretty much either these two can feed into the growth, and then the growth pays you and you live off that, or this feeds into this and you live off these two. It just depends on what you decide, right? But you never want to feed these two into the yield boosters, because the yield boosters will be your most unstable, unreliable, right? Right. Some month you might be really good, some month you might be really bad. So you want these two to be paying you, or one of these to, ideally one of these to be paying you, and kind of living off of that. Well, this one is like, pretty much your real estate, your gold, right? It's a hedge. So this is pretty much your preference. Can't really tell you how to do it, because again, I'm not in your situation. I'm not from Brazil. I'm not Brazilian. I don't really know what's going on. So I'm just going off kind of like what the comment has left me. All right, and then a case for diversification, right? The yield trap, you kind of you end up spending it all versus the amount of matrix, right? Um, Again, this is all illustrative, right? Um, the case for diversification, right? The dilemma, like what you're having, and possibly soon what I'm going to be thinking of very soon. Um, Unlike a working professional, right, we don't have active income. We cannot trade time for money to replace losses. A 40% drop in purchasing power is permanent, relying on single eroding assets, which is, if you own a yield trap, right, is an essential risk. Diversification, like the slide before, modern matrix ensure that if one engine stalls, the other keep the lights on, providing a safety net. A salary can be used to provide. So it's right now. I do have growth, and um I do have all three, um but they're all feeding into each other right now because I'm in accumulation phase. So I'm building, 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 right? So right now I own two yield boosters, which is Maggie and BTCI, and then my growth is QDevo, and then my core is the GPIX, GPIQ, and I'll be building out SpyI and QQI. And one more from Neos. I can't think of it off the top of my head. It's too early. I haven't had my coffee. But yeah, right. So this is just something, a checklist, something to think about, right? Reject the spend all mentality. Never spend the full nominal yield on a declining asset. You shouldn't be spending all of your monthly paycheck either way. You should treat all your payouts as a paycheck. Diversify strategies, right? Once you're in the consumption phase, you gotta start thinking about diversifying. You don't want to be all stuck into the um, raging leverage, you know, um, ETFs that does really well in an aggressive bull market, right? You're going to start looking into iSpy or SpyI or Divo, and then you're going to start kind of building those foundations up. And then you're going to also think about taxes, what you owe, what you might not owe. That's why I always say treat every payout like a paycheck, because you never know what you owe for the government, right? And I don't want to deal, for American me, I don't want to deal with Uncle Sam ever. And then automate the investment, but this might not be for you if you're already in a consumption phase, right? You want to start handling your own money. So that's it. That's all I got. I try to make it as detailed as possible, but it was a bit hard depending on um the information I could find. And I just didn't think it would be accurate if I put anything related to Brazil, since I know nothing about Brazil. Hope you liked the video. Hope you found it educational. Gave you a little idea on how you might want to start seeing things or start reevaluating your portfolio. Thanks for watching. Subscribe, comment, like. Catch you guys on the next. Stay tuned.